Introduction to Technical Analysis. Welcome guys. So in this video, we're going to just really talk about some of the most basic indicators and how to read charts. This really is just the beginner trader's guide to understanding charts and basic indicators. So some of the basic elements of charting. So some of the basic chart elements I'm going to go over today: candlesticks, volume, some other just general indicators, and trends. So let's start with candlesticks. A little bit of history around candlesticks. So it started in Japan around the 1800s. So there's some controversy. Some people think that it was started by this very wealthy, very successful rice trader's last name Hama. Some people are thinking, though, it didn't start until a little bit later after he had passed away. But regardless, it was brought to the West around 1990. And since it's come to the West, it has just exploded in popularity, showing how well of a tool it is for interpreting price action. Basic candlestick structure. Looking at the diagram here, we see a bullish candle, meaning that the price increased over the duration of this candle. We have the body of the candle and the wicks of the candle. The body of the candle shows where it opened. So when price action for this time period began, this is where it opened and this is where it closed. During the time of the candle, the price action was pushed up to this high and pushed down to this low. So it opened at this price. At some point in the trading period, it was pushed down to this low. The bulls stepped in and bought all the way back up at some point in the price action to the high, yet it closed here. So a bearish candle is decreasing in price action, meaning the open is here and the close is here. This is the body. And at some point in the price action, the high goes pushed all the way up to this point and the low was pushed all the way down to this point. So some examples. Here we're looking at the 1D Bitcoin chart, meaning that each candle is one full day of price action. So looking here, we have a large candle body. The price action opened here around a little below 13,000. At some point, the price action was pushed up by the bulls to above 13,000. It's rejected. The bears pushed it all the way down to almost 10,000, yet it closed here above 11,000. This is a large candle. Then we have really small, like indecision candles, where the price action is very small. The body is almost non-existent, and the wicks are also very, very small. Now, many candles have names, and many candle patterns have names. We're not really going to go into that for this video. That will be for another video, but just now really understanding the basic structure of candles. Now let's move on to volume. What is volume? Volume is the number of shares, tokens, or coins traded in a given time period. If it is measured in dollar volume, it is the number of shares, coins, or tokens multiplied by the share price it traded at. Now, really, I think volume is one of the most important tools for interpreting charts. So there are a couple rules for volume. Really, you want to see consistent volume and liquidity. This makes really for easier trading conditions. Meaning if you have consistent volume, it's more difficult for one order to push the price substantially one direction or the other. You also want to see a lot of liquidity, which makes entering and exiting your positions better. So as a bullish move in general, we want to see increasing bull volume, meaning that as the price action moves up, you want to see the volume also increase. This shows some authenticity and some momentum to the move. If we see decreasing volume on a move, it shows a lack of momentum in that direction typically. Now we'll look at a couple examples in just a minute. Another thing to keep in mind is a volume spike can show volatility potentially increasing. And again, I really think this is one of the most important tools in the trader's handbook. Here's an example. we have a move to the upside, a substantial move to the upside. This is a 1 hour Bitcoin chart, meaning each one of these candles represents 1 hour of price action. And so over a course of around 12 hours or so, we saw a substantial move to the upside. And during this move, we did see volume increase. Now, as it consolidated and pulled back, we saw volume decreasing. Now, this shows that there's more momentum to the upside than the downside. And fast forward in the price action, we can see in fact that the price action broke to the upside. Now, some other indicators. One, moving averages. So we have simple and exponential moving averages. Simple moving averages are calculation of the average closing price over a specific time period. Example, the 20 moving average, or the 20-day or 20 period moving average, would show the average closing price of the last 20 days. Now, exponential moving averages are calculated a little bit differently. They are giving more weight to the more recent price action, and they kind of seem to react a little bit quicker. Some rules for moving averages is they typically act as support and resistance, meaning when price is below the moving average, it will act as resistance, and when it is above the moving average, it'll act as support. Also, the higher time frame generally offers stronger support and resistance, meaning the 100-day moving average will offer more support than the 20-day moving average. Some examples. Here we see the Bitcoin USD chart on the 240-minute, meaning each candle is 4 hours. We have the blue line is the 50 moving average, and the orange line is the 100 moving average. We see here as price tried to move above the 100-day moving average, it was rejected. Now it was rejected here, acting as resistance to the 50. Resistance again, it did push up. This was on some news. Pushed up above the moving averages, came back for a retest, and now it was offering support. Here's an example of the exponential moving averages. Yellow line is the 50, and the red line is the 200. And we can see where it's acting as support and resistance. We have a lot of resistance in here. Was able to push through, and then now is acting as support. Now let's look at trends. So a couple components of a trend. Identifying an uptrend is a series of higher lows and higher highs. Series of a downtrend is lower highs and lower lows. Now, trends are really important thing to understand and be able to identify, as you really want to know which way the trend is going in order to get information on how you're going to place a trade and which direction you're going to want that trade to go in. So to play a trend, it's important really to look over several time frames. An investor may look over month, week, day chart. And if you're a day trader, you still want to be aware of what those longer term trends are, but it's more important where the hour and some of these lower trends are. It's important to trade with the trend, although opportunities do exist against the trend, but these hold times are generally much shorter. Example of a trend here, this is a weekly chart, the BTC weekly chart, and we can see we moved into an uptrend. We have a series of higher lows. This was the low, and we have a higher low, and now we moved into a higher high, a higher low, another higher high, higher low, higher high, higher low here, and then we lost the uptrend when we tried to push up again, creating a lower high and then moving down to a lower low. This signals that the trend is reversing. Now, there's really a lot of other indicators out there. Those are just some of the basics that I'm going to talk about in this video, but just so we have some awareness, and I'll go over these in future videos, there are many indicators. So a couple of them, RSI, Relative Strength Index. We have the Stochastic RSI, Bollinger Bands, the MACD, Ichimoku Cloud, and there's really many more. They're all tools to have in the tool belt, but use them with caution, as we can overanalyze and get analysis paralysis. We can also get conflicting signals, making it harder to make a decision and make a move when price action dictates. And really, that price action is king. The candlestick, the price action psychology is really just charting and depicting human emotions on a chart. And price action is what's really going to dictate most all of our trades. We let the markets come to us. We don't try and force our will upon the market. And understanding price action and what those candles are showing us is really the key to understanding technical analysis and the key to understanding how we're going to trade and place trades. Thank you guys so much for watching. I really appreciate it. Stay tuned for more videos.